And welcome back again to Tim Bigham's Big Time Options. We'll be taking a look at an update on our three big reasons to finally be bearish on Carvana research trade report that came out a couple days ago. So let's jump in and take a look, shall we? First of all, here is the IV. We always like to look at fundamental, technical, and implied volatility analysis, combine them in that fusion approach. So here's the IV from last Wednesday, where the trade idea really started from, right? You can see implied volatility at the lowest level we have seen in a very long time, had dropped from the previous day. You can see IV from Tuesday to Wednesday went from 14% to 12%, dropped across the board. Here's a longer term look. You can see IV approaching by far the lowest levels of the past 6 months. That's set up for a put buy combined with a overvaluation on a fundamental side and an overbought on a technical side. So let's see how that IV changed from Wednesday to Friday. Here is that same chart. You can see IV finally picking up after hitting basically the lowest levels we have seen pretty much over the past 6 months. So this is on the 60-day 30 delta, both put and call IV. You can see on a different perspective, we looked at the IV from the Thinkorswim IV percentile on Wednesday at 12%, had crept higher to 13%, but a move higher nonetheless. IV here is from Wednesday, December, and January, which was kind of our trades we were looking at, right? You can see December popped 11%. January popped 5%. Here you can see Wednesday when the trade was issued, right? IV had dipped below 50. Thursday it actually dipped a little bit lower. The stock actually went a little bit higher, so we didn't hit, if you will, the absolute perfection time, but as we'll see in a second, we did just fine. And then Friday you can see with finally the drop in the stock, IV back above the 50th percentile. You can see IV did move from Thursday to Friday. Here is that kind of look, right? The previous day, Thursday to Friday, IV picking up. So IV, as we anticipated, right, did increase sharply, right? These lows here prove to be lows that you probably want to take advantage of. On the fundamental side, here was Wednesday, December 10th, right? Carvana over $100 billion market cap. Price to sales, by far the highest level we've seen over the past 3 years. PE, the highest level by far over the past 3 months. So the stock getting absolutely overvalued on a fundamental perspective. We took a look at that, how much per car, if in essence, the number of cars sold will maybe be 600,000 over the upcoming 12 months with a $100 billion market cap, as we talked about. If we double the sales to 1.2 million, which is a huge increase in sales, values each car at over $80,000. Certainly rich on that perspective as well. Fast forward to Friday, we can see finally a softening, right, because of the drop in the stock in the price to sales and the PE ratios, right, both dipping back down from the recent highs here. So certainly the fundamentals finally starting to come in, have a long way to go. And we're seeing the market cap back below 100 billion. So I think we've got a ways to go, but we have a nice profit in the trade nonetheless. On the technical perspective, here we can see the chart, and we see a key reversal day on Friday where the stock did make a fresh new all-time high above 485 intraday, but reversed and closed lower and on pretty much the exact low of the day at 455. So a nice 30-point reversal. That key reversal day many times indicates the buyers are finally losing, control, right? The momentum is finally starting to weigh, right? The sellers are stepping in. So we always like this kind of key reversal day. It might signal a move back towards that 400 level, which is what our trades are predicated on, right? We can see 9-day RSI, which had hit a yearly high, certainly over the past 12 months, almost at 90, now back below 80, right, approaching 75. So RSI weakening. We see MACD, which had hit over 13, now back under 12. That's weakening as well. Bollinger percent B, which was over 100, right? So it had pierced, if you will, the upper band, now back within the Bollinger bandwidth range, right? And as we talked about IV, and this is a general perspective, but IV finally ticking up here. So taking a look at our trades, how did they do, right? Here was our original trades, right, from Wednesday, which was doing a put calendar, buy the January 410 puts, sell those December 410 puts, pay a little over $7.50. The diagonal a little more bearish, right? Buy those same 410 puts in Jan, sell the D's 405 puts, so a little more bearish lean, pay a little bit more, 783 for the trade, and then a simple longer term put debit spread, right? Buying the 410 put, selling the 400 put, and paying $1.78. Let's fast forward to Friday's close. I pulled off those trades, right? Here you can see the pricing on it, right? And if we go down, we can see our trades, right, moved up nicely. So that calendar spread trade, buying the January 410 put, selling the December that expires a week from, today, right, or Friday, cost a little over $7.50, as we said on the initial trade, right? Closed at about $9.85, right? Actually went out 9.89, but I rounded it down, right, to make it even more realistic. So a very nice gain in 2 days of $2.30, or just over 30%. The diagonal, right? 783 was our original price, as we said back here, to buy that diagonal. It closed at basically 1025, right, for a nice gain of $2.42, or again just over 30%. And then even that bullish or bearish put spread, right, buying the put spread, right, cost initially $1.78 net debit, right, able to, if you wanted to on Friday's close, get out at 220, right, for a nice gain of over 40 cents, or over 20% gain. So just having that IV start to tick up, right, and the stock start to tick down, right, the fundamentals starting to weaken a little, the stock back under $100 billion market cap, led to some very nice percentage gains. So certainly taking some of the position off on this recent weakness, right, would make sense. Maybe hang on some more, because as we've seen in the past, when Carvana starts to move lower, right, usually, like we last time we hit kind of the valuation heights here, we had a very nice drop, so it might have much further to fall here, which would benefit these trades. So hopefully it helps in explain kind of the insights we use to identifying potential trade opportunities using a fusion approach, a fundamental, technical, and probably most importantly, implied volatility analysis. So until next time, as always, here's to good trading. Take care.